Hello and welcome to Damien's Midweek Markets, which is the show where I talk about what's going on in investment markets and what to look out for in the coming week ahead. Now, we last did a show almost 2 weeks ago because we had an Easter break in the middle, and it's been a really interesting period. Those of you who do 80-20 Investor and are a member of my DIY investment service, that has been continuing to run throughout that time. But what we've seen is markets pick up, and we've had some changes which I'm going to run through now. Now, momentum has picked up in investment markets, and we talked last time about the DAX, so the German stock market, almost confirming the sort of bullish momentum that we've got in equities worldwide. And we've also started to see some confirmations from different sectors, because what you want to see in America in particular when we're looking at the S&P 500 is a confirmation from other sectors, different sectors, that there is an overall bullish trend. Now, you don't just always want one sector to lead the way, because at the moment what we've got are the tech stocks. They're flying. Now, the tech sector is a real growth story, because don't forget, all their earnings are way off in the future. And what we've had is those have rallied very strongly this year after they sold off in a significant way at the back end of last year, and actually started some of the wobbles that we saw in the stock market. Now, they've been rallying very strongly, and there were signs that while they led the market high in 2018, we wanted to see some follow through from other sectors, and we started to see bits of that. Healthcare stocks, they actually had a very bad time in the last couple of weeks, and there was worries that it was a sign that we may start to see some other divergences within the stock market that may hint that things may start to dip. They've had a pickup in performance, so we always want to look for those confirmations in different places, and we've seen some positive signs. Again, there are still those negative divergences in there somewhere where certain sectors aren't all playing ball, but it is still a slightly more bullish bias, and that's been confirmed even more so by what we've seen in the S&P 500, because we've hit a new all-time high. Now, it's not just one all-time high, we've had a number of all-time highs in the last week or so. So we had it in tech stocks first, the S&P 500 pushed up to new all-time highs, and we're probably going to see the Dow Jones Industrial Average push to a new all-time high. Now, new all-time highs after a correction that we've seen tends to show that it's confirming that that downtrend is over, and actually it was just a correction in an ongoing bullish phase. To confirm that fully, what we'd like to see is the stock market to leap higher. Now, if we go over to America, the S&P 500 is sitting now around 2,950. So it's leapt up about 50 points from the last time we did this show, which pushes it through those old all-time highs we saw in September, October time. Now we're pushing higher. If we can get momentum to get up to 3,000, that really does throw down a marker, and I think you'd find hardly any bearish investors left in the market, which in itself can be a contrarian indicator. Now, one of the catalysts for this was being the earnings seasons we've had. Earnings season in America and in other places around the world has been largely positive, perhaps I shouldn't say positive, it hasn't been as bad as some people feared. There have been some real highlights. So if you go in again, the tech, we're talking about tech stocks a lot, but Facebook, we had Microsoft, they all had some stellar earnings reports. Of course, it's not all going to go the bull's way, because Google had some disappointing results, but it wasn't enough to set the market into a downward trend to cause a wobble. And because Apple has done so well, you always hear that adage, as goes Apple, so goes the stock market. It doesn't always hold, but because of its size and influence on the indices in America, it is important. And its earnings report was received well on the 30th of April, then that's actually helped underpin the market at the moment. We talk about the VIX, the fear index. You can just have a look at that, and that is still sort of plumbing lows of about 12, sometimes bounced up to 13, but it's not getting above that 15 level at the moment. So there really is very little fear in the stock market. If we want to see fear, what level on the S&P 500 would people start to get a little bit spooked? I think if we break down below 2,900 and maybe 2,890 and lower, then I think people will start to question the uptrend and whether we're going to get to a double top. Now, until we break higher and we head towards that 3,000 point, you're going to probably hear the term double top more often than not if we start to get a little pullback. The market has rallied so strongly. we're almost certainly a bit stretched. We almost need to have a little bit of pullback, so some respite from the almost seemingly never-ending rally that we've had in 2019. But if we do, then you're going to get people start to talk about double top formations. Now that's a formation in the stock market. If you think of it, look at your stock market app. If you open it up and go back on the S&P 500, for example, you will see in September the market peaked. It then sold off in October. It then dipped down to a low on the 24th of December, so Christmas Eve, and has pretty much since rallied back upwards again. If we were to then suddenly sell off from this point, you can see you will get a formation that goes up, down, a double top. That can be a very bearish sign, and if it does, then we could be looking at lower lows. But it seems the statistically less likely thing to happen at the moment, given what we're seeing in the stock market indices and the underlying stocks themselves. So that is a level to keep an eye on, 2,890 on the S&P 500. Elsewhere, what's going on? The German DAX is still proving fairly strong. We're seeing some positive action in European equity markets. And the FTSE 100, although it's pulled back from where it was recently in the last week, it did break above that 7,500 level. So while it looks very good for the bulls, everybody is thinking that we're only going to head higher in the stock market. You've always got to be mindful of the other side of the coin. Now, some things we've got coming up that could be either positive or detrimental to the stock market rally is the Federal Reserve's latest interest rate meeting, and we're going to get some news on that this week. We're also seeing some strong dollar signals. So if you go and look at the dollar index, it's an index that basically weighs the US dollar against a basket of currencies around the world. And as the dollar gets stronger, just like when the pound gets stronger, it hinders the FTSE 100, you get a similar action in America. And there will be a point, if the dollar keeps strengthening, then we'll get to a point where it can be a headwind for stock markets. We're not there yet. 80/20 investor members have been given some commentary and insight looking at levels on that dollar index to watch. That could be a sign that the dollar could get stronger, or in fact if it weakens, then that will be a tailwind for the stock market. The other things to have a quick look at and worth watching is the US 10-year Treasury yield, which we talk about on your stock app, versus that S&P 500. So it's really a bond market versus the stock market. Now, if everything's rosy, the stock market is telling you everything is awesome, but the bond market is still suggesting that everything isn't. Now, maybe one of them has to be right. History says one is going to be right, one is going to be wrong. But perhaps with the US Federal Reserve having a very dovish stance and basically supporting the market, what we've had here is that it's changed the dynamic, it's changed the backdrop, and maybe we could get to a point where actually both are right for different reasons. And that is something that I'll probably come on to for 80/20 investor members going forward. So that is it for this week. If you have any burning questions, then do send them into the usual address, Damien at moneytothemasses.com. And of course, you can catch me on Twitter at moneytothemasses. And please leave reviews for this podcast and show and share it among your friends. So until next time.